Welcome to Retiring Well. We've got a great show lined up for you. There's been a lot of press about the big, beautiful bill. Well, we're going to be talking through the 5 tax changes that you should be paying attention to. Along with that, are you getting misinformation when you do your online research for financial planning? There's a lot of different tools out there. Be cautious. And then what is a QCD? How could that benefit you in your retirement plan? And then discover your perfect rate of return. What does that look like for you in retirement? So all this and a lot more coming up right here, right now on Retiring Well.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well. Plan to retire well.
Well, if you haven't been buried under a rock lately, you've probably been hearing about some tax changes in a bill that was recently passed and talking about that. And John, you know, when we talk about investments, retirement planning, obviously taxation's maybe one of the biggest, if not the biggest thing that people forget about. Well, it's been thrown in your face quite a bit recently with this bill going around and all these various things out there. And we wanted just to take some time and kind of dive into that here on Coffee Talk this morning and just get into that. And some of the changes, now again, kind of preface some of this with the fact that this isn't everything. There's a lot of things in there, and every person's situation is going to be uniquely different. There's income limitations. There's, you know, if you're single, if you're filing jointly, if you're married, filing separately. There's a lot of different qualifications, so keep that in mind. So importantly, you know, make sure you're doing your planning on this. Make sure you're seeing how it affects you, and not just the fact of when you walk in to have your taxes prepared here, you know, next spring, but let's start with this now and seeing where there's some opportunity out there for you, doing some forward looking and some planning, and you know, kind of some of these things that you hear about from us today.
Yeah, and we're going to walk through probably 5 major ones that that may be of importance to you. And like Art said very well, like you're going to want to look at your specific situation and make sure that they apply specifically to what you're trying to do. So the first, this permanent extension of the 2017 Tax Cuts and Jobs Act as far as the tax rates. And so we saw a lot of folks that were able to enjoy I'd say 3% typically. So for folks that maybe in the past were paying a 15% tax, we're paying 12% tax. Well, that's been extended permanently now, which was set to originally expire here in 2025. So that's one major area that I know a lot of folks we've been looking at for Roth conversions and how to transition money from IRA to traditional IRA. Well, they're in that maybe what we would have considered a lower tax bracket to try and take advantage of that. And then the other one, this raised SALT, or if you don't mind defining what SALT is.
Right. It is interesting when I hear that SALT, even being in this industry, it takes me a minute to think about it, but basically state and local taxes, you know, the taxes that you're already paying here in theory locally in your own state, or some cities even have taxes and stuff like that. But think of it as just those, it's a deduction of what your taxes you're already paying. They're basically raising that threshold of those deductions you're able to get off of that. Now, again, these are income limitations and stuff like that with this, but effectively it's been raised up to about $40,000 for some of that you, again, depending upon where your income falls, could be a sizable benefit if you get into that when you think of those state and local taxes you're already paying anyway.
Right. The third is these new above-the-line deductions for tips, overtime, and auto loan interest. So with tips, there's, I think, $12,500 individually, $25,000 for joint. Overtime has sort of the same caps as tips, but then for auto loan interest, up to $10,000 for U.S. assembled vehicles. So if you have a loan and you're able now to potentially be deducting that interest. So that could be valuable, and especially considering it's for U.S. assembled vehicles. And then the fourth, Art, this enhanced standard deduction and senior deduction may be of great value.
I think this might be some of the simplest ones for folks, because it seems like anymore most people are taking the standard deductions. When this 2017 come around and that massive increase of standard deductions, a lot of people weren't itemizing anymore. So some of these benefits we're talking about, you weren't experiencing those anyway because you're just taking the standard deduction. Well, Good news for you, if you're taking that standard deductions, we've seen a little bit of an increase in that for both single filers and married filers, but then also kind of this premium deduction for 65 and older. So those of you that are out there retired, you're going to see a nice enhanced deduction from that, and that's upwards of an additional $6,000, again, depending on income and all that sort of stuff, but could be a significant benefit for you.
And lastly, we'll get into the permanent increase in child tax credit, estate, gift exemptions, qualified business interest deductions, and then another notable change is the charitable deductions. This up to $1,000 for single, $2,000 for joint, for non-itemized deductions, or for those of you that are non-itemizers. So anyways, there's a lot of great benefits here that may be of value to you. I know I was talking to a client recently and they said, well, we went through it and that actually saves us a few dollars. So be looking into that, and if you have questions, feel free to reach out to us.
If you are nearing retirement or already retired, we invite you to an exciting and informative live event with a complimentary gourmet dinner to help you plan to retire well. There is no cost and no obligation, and dinner is on us. Information is power. Let us help you make educated financial decisions, such as understanding Social Security do's and don'ts. What year-end tax planning opportunities should you consider? Is your financial plan still on track? Alphabet soup with retirement plans. What should you be using? Asset location versus asset allocation. Which matters more? We are Centennial Wealth Advisory, financial professionals, specializing in retirement planning and serving all of northern Michigan, with offices in Traverse City, Gaylord, Petoskey, Cadillac, and Manistee. Call 888-608-5825 or register online and choose the date and location that works best for you. Tuesday, September 9th at Boone's Long Lake Inn in Traverse City. Wednesday, September 10th at the Hampton Inn and Suites in Manistee. Wednesday, September 10th at the Perry Hotel in Petoskey. Tuesday, September 16th at Slate in Traverse City. Wednesday, September 17th at Treetops Hunters Grill in Gaylord. Or Wednesday, September 17th at Ferris State University in Big Rapids. The live event starts at 6:30 p.m. and is free to attend, with a complimentary gourmet dinner to follow. But seating is limited and tends to fill quickly. Call 888-608-5825 or register online to reserve your seats today. Don't miss this important live event to help you plan to retire well. After more than a decade of stock market growth, volatility jolted investors back to the harsh reality of occasional market pullbacks in the investing cycle. Download our free white paper, Navigating Market Volatility. It's all about perspective, for an in-depth analysis of historic lessons and time-tested investment strategies. Simply go to sen-wealth.com, scroll down and click the link Navigating Market Volatility. It's all about perspective, to receive your free copy of this valuable and informative resource.
Opinions about how to invest are everywhere online these days, and that's starting to lead to some problems. The recent study conducted by the CFP board, this is the group that oversees a certified financial planning credential, which is kind of the gold standard in the financial community. In this survey, they reported about 57% of people have made decisions that they've read online, and they've regretted it later based on misleading information. Of that group, about another half of them reported some sort of financial loss, in some cases over $1,000, based on this misleading information. Now, when we look at the information out there, we're inundated with ads, whether that's TikTok, LinkedIn, Facebook, of all this information, and everybody, of course, is an expert. The problem that we're seeing is people are mistaking popularity with actually having credentials and the expertise in these different areas. You know, just the other day, I was reading a post on LinkedIn of somebody that I know locally that works in the financial area, and they were talking about life insurance. And they're talking about if you want to be a high net worth or ultra wealthy American, you need to be using a whole life insurance policy. And I started to laugh because in this article, they're talking about Jeff Bezos and how he's probably using these types of policies. I started thinking, I don't think Jeff Bezos is as wealthy as he is because he put $100 a month into a whole life policy. So it's like, let's start to take a step back and actually look at what the message is in some of these situations. First off, this individual doesn't have a college education. Not saying that's a problem, but it's just something we need to be aware of. They don't have a financial advising license. They actually haven't passed those tests. What they do have is an insurance license. So of course to them, every problem, the solution is going to be buy an insurance policy because that's what they can sell. So this individual is trying to, of course, sell more policies. Nothing wrong with that, but they're misleading individuals, putting them into a product that is going to have not necessarily a bad outcome, but not necessarily meet their goals very effectively. And he's putting that out there so that everybody can see it. Another scenario, I met with someone recently that they've been a viewer of the show. They're big on Dave Ramsey. They're coming in and they want to buy mutual funds. They're younger, they're starting out saving. I'm not saying mutual funds are bad, but this idea that we're giving general advice from Dave Ramsey of everybody should have mutual funds isn't necessarily appropriate. Now, as we kind of dig into this situation for someone starting saving, well, mutual funds tend to have a little bit higher costs, especially if they're actively managed. They tend to have higher ticket charges depending on what platform you're buying them on. And then thirdly, if you're owning it in an after-tax position, you might have some phantom income or gains, sort of uncontrollable tax impact. For that individual, we probably want to think about more of a passive, cheaper investment approach just to get those assets working for us as much as we can. Now, in both these scenarios, I'm not saying the advice that was given to them was necessarily wrong, but it wasn't tailored to their financial situation and their specific goals. And that's the issue that we're starting to see is we have a lot of individuals coming in, making decisions based off these different platforms and this information given out, and it's not tailored to you. So we want to take a step back and we need to be thinking about, okay, let's meet with someone that's actually a licensed advisor that can sell us multiple different types of products, that maybe they're a certified financial planner like myself, or they have a tax team like we have here at Centennial Wealth Advisory, so that we can look at all of the pros and cons of how these different products work, how these different strategies work, but more importantly, work with you to start to develop that overall financial plan. Because what we want to start to avoid is taking just pieces of all of this information out there and trying to put it together ourselves and not fully understanding what can happen to these policies long term. Like in that whole life policy example, if someone starts that policy up, they're going to be committed to that for a long period of time. If they try to cancel that early, they might lose all of the money that they've put into that. So some of these decisions around like pension, Social Security, life insurance, they're somewhat irrevocable. We need to make sure we have an expert that's helping us make those decisions, not just pulling data from different sources and quoting it, trying to say that's what Jeff Bezos do, because let's be honest, he's not buying a whole life policy. His situation's a little bit more complex than that. But the point is again, we mistake popularity with actually having competence in the financial world. And I encourage you, before you go meet with individuals, make sure you vet them, make sure they have the licensing in place, they have the different credentials so that the advice they're giving you is from that expert point of view. And if you don't know where to start with that, I encourage you, we always offer on the show, come in for a complimentary meeting. We're happy to sit down with you, review what you're doing, review what you're being told, and make sure it actually does align with your goals and your values to make sure we're not part of that percentage where we're regretting this in 1 year from now.
Living life isn't always easy. It puts up challenges and obstacles you'll have to overcome. There are responsibilities. You put in effort to provide and take care of your family, to save and invest, to balance work and life. Planning is the first step to succeeding. Plan to retire well.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
As individuals move throughout retirement, they often look for ways to give back while keeping an eye on their taxable income and also taking into account those pesky required minimum distributions. And wouldn't you know it, we have a great tool out there that can accomplish all three of those goals. It's called a QCD, or Qualified Charitable Distribution, and that's what I want to talk with you about today. I want to go over what a QCD is, what are the benefits and various rules that you need to follow, and why you might want to have these QCDs as part of your retirement plan. So first up, what is a QCD? Well, the QCD stands for a Qualified Charitable Distribution, and it allows you to take money out of your IRA and direct it to a charity without paying any taxes. So it is a great tool that you can use. Now, if you've been watching the show a long time, you know that with IRA accounts, all that money you put in there, it hasn't been taxed yet. So if you were to just take the money out of your IRA and put it in your pocket, it's all taxable. But this QCD allows you to take the money out without paying any tax from that IRA. But there are some rules that you need to follow with these QCDs. The first one is you have to be of age. So the magical age is 70 and a half and older. So once you hit that point, you can take advantage of these QCDs. Now there are some limits though. The distribution limit for 2025 is $108,000, and that is usually adjusted for inflation every year. So 2026, that'll probably go up a little bit. But also rule number 3 is you got to make sure that the money is going to a qualified charity. Okay, so you can't just say, hey, you know, my son or my granddaughter, they're a charity, I'm going to give them some money. It doesn't work like that, okay? It's got to go to a qualified charity, so to your church or to a different 501c3. It's got to be that qualified charity to get that tax break. Okay. Now, one of the great benefits of these QCDs is, of course, the tax break, but also if you're of RMD age, or required minimum distribution, age 73 and over, these QCDs, they actually qualify to, you know, take care of that RMD. So that's a huge benefit. Usually the question when I bring these QCDs up to clients or prospective clients is, well, how does this really benefit me? Well, how does this work in my retirement plan? And ironically, I came across a couple just recently out of the Gaylord office where it made a whole lot of sense for their situation. And I want to go over that with you. So this couple, they came into the Gaylord office. They were 74. He was 74. She was 71. They had been retired for a few years. And through conversation, I learned that they were very active in their church, giving both of their time and their money. I learned that right now in retirement, they're living pretty much on Social Security and then distributions from their IRA. And every Sunday, they cut a check and they put that check in the offering plate. I spoke on QCDs a little bit, and they had never heard about these qualified charitable distributions. And so I went over it with this couple. I explained that right now for them, what they're doing is they're taking money out of their IRA, they're paying Uncle Sam, paying those taxes, and then putting what's left in their pocket. And then come Sunday morning, they're cutting that check and putting the check in the offering plate. And so I told them, you know, technically what you could do to avoid taxes is take the portion that you're tithing every Sunday and have that go directly from your IRA to the church, and you wouldn't have to pay tax on that. And they were a little hesitant at first to do this because they're like, well, we've been tithing for so long. We've been putting that check in the offering plate each Sunday. But then when I further explained to them that, you know, theoretically, if they wanted to, they could actually give a little bit more to the church, because they could say, hey, this portion, it's not taxable, Okay, and yet they have been paying tax on that portion that they're tithing. So if it goes directly to the church, they don't have to worry about the tax consequences. And at that point, they were all about it. Now, in this case, it was a perfect situation for them. They knew they were going to contribute or tithe so much per year, and it worked out where the qualified charitable distributions made a whole lot of sense. Now, it might not be for everybody, but if you're over the age of 70 and a half and you're a giver, you want to make sure that you're checking this out, especially if you're taking money from that IRA. So if you have questions on QCDs, please don't hesitate to give us a call.
Centennial Wealth Advisory is expanding, and we are excited to add a new office in Manistee to better serve our growing family of clients. Our new office is located in the historic Briney Building in the center of idyllic downtown Manistee. Whether you are an existing client or would like to meet for the first time for your free, no-obligation initial consultation, we look forward to welcoming you in our new office or at any of our Northern Michigan locations in Traverse City, Gaylord, Petoskey, Cadillac, or Manistee. If you are nearing retirement or already retired, we invite you to an exciting and informative live event with a complimentary gourmet dinner to help you plan to retire well. There is no cost and no obligation, and dinner is on us. Information is power. Let us help you make educated financial decisions, such as understanding Social Security do's and don'ts. What year-end tax planning opportunities should you consider? Is your financial plan still on track? Alphabet soup with retirement plans. What should you be using? Asset location versus asset allocation. Which matters more? We are Centennial Wealth Advisory, financial professionals, specializing in retirement planning and serving all of Northern Michigan, with offices in Traverse City, Gaylord, Petoskey, Cadillac, and Manistee. Call 888-608-5825 or register online and choose the date and location that works best for you. Tuesday, September 9th at Boone's Long Lake Inn in Traverse City. Wednesday, September 10th at the Hampton Inn and Suites in Manistee. Wednesday, September 10th at the Perry Hotel in Petoskey. Tuesday, September 16th at Slate in Traverse City. Wednesday, September 17th at Treetops Hunters Grill in Gaylord, or Wednesday, September 17th at Vera State University in Big Rapids. The live event starts at 6:30 p.m. and is free to attend, with a complimentary gourmet dinner to follow. But seating is limited and tends to fill quickly. Call 888-608-5825 or register online to reserve your seats today. Don't miss this important live event to help you plan to retire well. After more than a decade of stock market growth, volatility jolted investors back to the harsh reality of occasional market pullbacks in the investing cycle. Download our free white paper, Navigating Market Volatility. It's all about perspective, for an in-depth analysis of historic lessons and time-tested investment strategies. Simply go to cen-wealth.com, scroll down and click the link Navigating Market Volatility. It's all about perspective, to receive your free copy of this valuable and informative resource.
Hey, welcome to this segment on discovering your perfect rate of return. So what I've been doing over the last few years is figuring out what happens with all of the different data that people want to give us. What happens if you were just to make 0% rate of return? Let's look at your plan like you took everything that you've saved, you buried it in your backyard, and then when you needed some money, you just went and took from it, okay? So that's the framework in the discovery at the very beginning. So recently, I had a client come in, they were 59 years old, and they said, hey, we're thinking about retiring in a few years. We've saved up about $500,000 in our 401k, and we have $50,000 in a Roth and $50,000 in our, at the bank. And they said, what would it look like to retire at 62. So I put all this into a really cool program that we use that crunches all the numbers, gives us projections that are very interactive. It'll give us legacy stuff, tax planning stuff, income gap, and it's all right there. So you're gonna get some visuals today for that. And so by using a 0% rate of return, we get to see what they would have to make in order to never run out of money. And so the first example, we just said, well, let's look at what happens, if you retired at 62. So like I said, they save $500 grand in their 401k, 50 in a Roth, 50 in a bank. They have a $300,000 house, okay, in their protected asset column. Their goal was to spend $5,000 a month with a 3.26% inflation. So that spending would just grow every single month. So you see your net monthly expenses, by the time they would retire, it would be $5,232 a month going out, which would give them an income gap of $3,102. That's what they would be pulling from their portfolio savings. At a 0% return, that would last them until they're 77 years old. They said, well, I don't want to run out of money at 77. Okay, in order to do that, in the upper right-hand corner, you'll see they would need to make 6.82% every single year for the rest of their life. So then the natural question is, well, can I get 6.82% every single year for indefinitely? Well, let's talk about risk, right? What kind of risk do you want to try to get that? And they said, well, that seems higher than our comfort level. Said, okay, all right, well, how much do you like your job? Do you not like your job? Yeah, I kind of like my job. It's still fulfilling my mission in life right now. So what if we went and looked at me working until I was 65, okay? So then what we did is we said, all right, let's look at 65, but let's tweak the spending just a little bit. You're debt-free, and by working a little bit more, you can pay off any little debt, save up a little bit more. And so now we tweaked it to where they'd be spending $4,500 a month after tax with a 2.5% inflation. Then what happens is that would kick their money all the way out until they were 93 and 92 years old. And in order to never run out of money, they would have to make 0.84%. And they said, okay, well, that seems like very, very possible, very likely we could do that. And it's like, yeah, okay, I don't know if I want to work that late, that long. I said, okay, well, let's go to the next scenario. Let's say, what if we looked at what 63 would be? So we said we are retiring at 63. We're going to keep the $4,500 a month spending after tax, and then a 2.5% inflation. That got their savings all the way out till they were 82 years old. And in order to never run out of money, they would have to make 3.94%. And they said, okay, that seems way more feasible, and then we talk about what the market options from no risk to market risk and everything in between. And so then they have a much better way of how they could structure their portfolio with a retirement age of 63. And we didn't even talk, and I didn't even get to show you yet because it's such a time crunch here, what tax planning looks like, okay? If you start putting tax planning and you start getting tax efficiency in there, then these numbers get even better. And then the final one is, okay, let's just look at what a 4% rate of return. So this very last screen, here's what happens at 4%. Keep all the same variables. We go back to age 82, and they still have $585,000 in their spendable asset column. So when it comes to long-term tax planning, when it comes to legacy planning, income planning, when you want to figure out what the best, most optimal rate of return that you might be shooting for, you give us a call. No obligation, and we can sit down, we can crunch your numbers and give you the rate of return that might be best for you. Thanks for watching.